So is it possible to find a Canadian stocks that has a yield above 5% and that will not let you down? We all want income, but you don't want to old stocks like BCE, for example, that within 3 years cut their dividend by more than 50% and leave you with a big hole in your portfolio. So today I decided to dig a little bit further using the DSR stock screener, trying to find companies with a high dividend yield, but also with good financial metrics. And I found 3 that are super interesting. So the way it works is I went on the DSR stock screener and I look for companies with a minimum pro rating of 3 and a dividend safety score of 3. So those are like our own ratings, just to make sure that we meet the bare minimum of a solid company that has some dividend growth coming up. Then I looked at only companies with a forward dividend yield above 5% and with a dividend growth policy of at least 1% per year. So it's not much, but I did not want to look at companies with no dividend increases over the past 5 years, because a stable dividend is a passive dividend cut. When you think about inflation, you have to factor that in. So let's get started with the first one on my list. Canadian Natural Resources, CNQ.TO, with a yield of 5.75. On the bull case, Canadian Natural Resources as the largest oil and gas reserve. We're talking about over 32 years of proven reserve. So they are sitting on very high quality asset and they are not about to run out of commodities at this point. The second thing that I like about CNQ is the fact that they are able to constantly generate free cash flow regardless of the commodity prices. That is a common problem within the energy sector, where you have a weak oil barrel or weak price for natural gas, you will also have a company that goes into debt and cut their dividend. Well, it's quite the opposite for CNQ, because they have low capex requirement to produce and they can ramp up production when prices increases, which means even more cash flow during good times. Finally, that ends up into being a dividend growth machine. As you can see, we have over 20 years of consecutive dividend increases. Besides Imperial Oil and Enbridge, there are very little number of companies that are able to do that. The reason why I selected CNQ over Enbridge actually is the fact that CNQ is vertically integrated and right now shows kind of a good price weakness to enter into it. Of course, it's not buy or sell recommendation, and I'm not your financial advice. You have to do your due diligence before going into any position. So as nothing is perfect, we also have a bear case for CNQ. Unfortunately, even though the company is sitting on high quality asset and it's still profitable, even with an oil barrel trading at $35, the stock price will follow the oil barrel price. As you can see on this graph, whenever it goes up, the stock price will go up, but whenever it goes down, as it is the case in 2025, well, CNQ is having a lot of hard time to generate returns. That caused a lot of confusion and comprehension for investors, because they're thinking, well, this company is making a lot of cash flow, they are increasing their dividend, and yet the total return sucks. Well, if you want to know a little bit more about why a stock price move up or move down and which kind of decision you have to make, I will have a free webinar explaining you how to analyze a stock, how to frame it in the right way so you can decide to buy or sell a specific position. And all of this will happen on September 18. There's a free webinar at dividendstocksrock/webinar. You register there, your place will be guaranteed, and I will show you a framework telling you how to ignore stock market noise and when it's time to listen to it. All right, let's get back to now number 2 on my list, Brookfield Infrastructure, BIP on the US side, or BIP.UN.TO, with a yield of 5.70. The first reason why I like this stock so much is because of its diversification. Brookfield Infrastructure is like holding an ETF of utilities. You have data centers, you have midstreams and pipelines, you have classic utilities, and you also have transportation such as railroads and ports. So you have everything that are long-term assets that generates cash flow, that are super stable, and they are linked to what I call being patient capital. So assets that will generate for the next 50 years and more. And you can see that there's a trend where they're investing a little bit more in data centers, and this portion is growing within the business. What I also like about Brookfield Infrastructure is their asset recycling strategy. So that is at the core of their business model. They are buying an asset, they're improving it, so generating more cash flow from it, and then they sell it at a profit so they can buy another undervalued asset and repeat the cycle over again. Finally, having a great diversification and a strong business model leads to great FFO growth and great dividend growth. Between 2009 and 2024, the funds from operation per unit increased at a rate of 14% per year. And for the dividend, it followed at 9%. What does it tell you? Well, there is more funds from operation than there is of dividend distribution. Therefore, the payout ratio is lower today than it was in 2009, which gives a lot more room for Brookfield Infrastructure to A, use their playbook of asset recycling, and B, continue to increase their dividend. Again, nothing is perfect in this world, and Brookfield Infrastructure is also coming with a solid bear case. The biggest problem with Brookfield is its complexity. So when you look at the dividend triangle that we use to analyze stocks, you will notice two things. The first one is the earnings per share are definitely not following the dividend growth. So it creates a lot of confusion because when they do asset recycling, that also means that they do a lot of acquisition, there's a lot of amortization, and that affects earnings. So that's why you have to use funds from operation, or FFO, to determine if the dividend is safe. Now, if you look at the dividend graph, you also see that there was a small cut at one point. Well, it was not a cut. It was because they restructured the company, they issued more shares, and on top of having trust units, they also have corporate class shares. I told you, complexity. Again, it's harder to understand this type of companies. It's harder to follow classic metrics because you also have to make some adjustment. If you want to learn more about how to make those adjustments and understand a little bit more how to read quarterly earnings, I will also show you that in my next webinar on September 18th. So you can register for free at dividendstocksrock.com/webinar to understand how to read quarterly earnings and determine which metrics is important depending on the business model of the company. Now moving on to my last high yielding stock, CT REIT, or Canadian Tire REIT if you prefer, CRT.UN.TO, with a yield of 5.80%. So what I like about this one, well, when you're thinking about REITs, you think about stability. So CT REIT is the perfect picture for stability. On average, their lease are 7.5 years. They are including an escalator rate of 1.5 to match up a big part of the inflation, and they show a 99.5% occupancy rate. In other words, all their properties have tenants and they're paying more every single year. So it's great if you want to increase your distribution, and as a retiree, it's perfect because you get a good yield, but you also know that your distribution will match inflation moving forward. I also like their growth strategy, which includes three factors. So the first one is redevelopment. So they improve already what they have so they can increase the rent and then charge a little bit more to their tenants. The second factor is retail intensification. So what it means is they have usually large parking lots. So they expand their properties, they make it bigger, or they include more retailers inside of those properties to again increase their revenue. Finally, they also go into new projects. So they develop new retail by buying more lands and building more retailers there. And this entire strategy works very well. When you look at the dividend increases, well, actually, when you look at the distribution increases versus the payout ratio, well, you see that there's a constant increase for the distribution, which is amazing for investors, but also a constant diminution of the payout ratio. So again, they benefit from plenty of room to grow their portfolio of properties and at the same time increase the distribution so you're not left on the sideline and see your income getting eaten alive by inflation. There is one thing I don't like about CT REIT, and it's its tenant diversification. It's kind of ironic because they almost try to hide it in their investor presentation. When you look at their top 10 tenants, you will see big names such as Winners, Loblaws, BMO, Walmart, But then if you go back and zoom in at the bottom of the total 10 tenants is only 4%, which means 96% of all their properties are rented by one single tenant, Canadian Tire. So the big downside here is when you invest in City REIT, you not only have to monitor the REIT, you also have to monitor the other company that is the major tenant, Canadian Tire. So far, so good. It's an iconic brand. It's everywhere in Canada, very stable, but yet you're never shielded from a tenant that goes into trouble. And in this case, if Canadian Tire slows down and gets into trouble, City REIT will follow automatically. So all right, guys, that's enough for today. I hope that you have enjoyed this video. Do not forget to subscribe to the channel and give me a like. Let me know which are your favorite high yielding stocks. I'm sure I've forgotten a lot of those, so I'm going to look in that in the comments. And do not forget to register to my free webinar about avoiding price confusion, understanding quarterly earnings, using the dividend triangle to make buy and sell analysis. You go to dividendstocksrock.com/webinar to register, and we're going to talk again next week. Until then, don't forget to stay invested.